This is the Asia Climate Capital podcast hosted by me, Joseph Giacobelli. The series is dedicated to discussing and analyzing business and finance topics around the energy transition and decarbonisation in Asia, with the capital markets in mind. Hi, this is episode 14 of the Asia Climate Capital podcast, recorded today on the 11th of August 2022. I'm your host, Joseph Giacobelli. Today, what we're really talking about is sustainable finance, climate finance, and investing, and two sides of it. One is the reality, and the other side of it is what I think is a whole lot of bubble. I mean, if you haven't realized that, there is a climate issue, and there's a bunch of assets that are going to be affected. Plus humanity is going to be affected in general, then probably, you may be sleeping at the wheel, like they say. Today, I have the great pleasure and honor to have Matt Orsagh. He's a director, the capital markets policy at the CFA Institute. And by the way, also he's the host of a very popular podcast called The Sustainability Story, which I urge you to listen to. And what we're going to be discussing with Matt is really, first, from a global perspective, at a high level, what is going on in terms of climate finance and investing, the importance of some of the major drivers. And then after that, we'll talk about the future and the way that based on his, quarter of a century experience, what he thinks is going to happen going forward. So as always, note that all of the views and opinions are purely personal in nature and do not reflect those of past or current employers. So hello, Matt. Good morning, Hong Kong time, and good evening, Virginia time. Welcome to the Asia Climate Capital podcast. How are you?
Good. Thanks for having me, Jeff.
Thank you very much for your time, especially so late at night, your time. The Asia Climate Capital podcast, Matt, is all about the fastest growing subset of finance and investing. And it comes under a variety of shades of green with terms that are often interchangeable, including, green finance investing, climate finance investing, sustainable finance and investing, ESG finance and investing. You have written and publicly spoken quite extensively on the subject. Could you please share with us how and when did you start tackling this topic, please, Matt?
Yeah, well, thank you for saying that I've been in this business for a quarter of a century. That's a great way to make someone feel old.
Sorry about that.
But that's nearly true. It was about 2001. I started working for a company. I lived in New York. Started working for a company that was just starting to look at corporate governance, integrating corporate governance into the investment process. That company was called Governance Metrics International, GMI. It was bought a couple of years ago by MSCI. It's now part of the MSCI family. But back in those days, as I said, people were just starting to integrate corporate governance into the investment process. Not really the E and the S yet, very much of ESG. And geez, I read in our team, more proxies than any person should ever have to. I joke there was a form of torture in some countries, reading that many proxies. But we were trying to dig out what was material, what was important from all those companies. And we were looking at, the amount of metrics data we gathered. We probably gathered about 600 to 700 data points, if I remember correctly, on every company. And now, if you look forward to today, and folks like SASB, Sustainability Accounting Standards Board, has narrowed that down to 6 to 12 metrics, depending on the sector, depending on the company, that really matter, that really are material. But that work started, about 20 or so years ago, and I was part of that. And I was getting my CFA charter at the time. I got my CFA charter in 2003. And I remember studying for my CFA charter. Corporate governance wasn't in the curriculum. And of course, ESG wasn't in the curriculum. But about a year after I got my charter, corporate governance got in the curriculum, and I remember because I was upset that it didn't come into the curriculum a year earlier, because I would have known I wouldn't have had to study for that part because I knew it so well. So corporate governance made its way into the ESG curriculum, or the CFA curriculum, about 2004. And then the next year, 2005, and then into 2006 was when PRI launched their Principles of Responsible Investment. They really codified the term ESG. And that's when we first started hearing about ESG. And I remember it was about 2007, 2008, where the E and the S started making their way into the CFA curriculum and MBA curriculums and business school curriculums around the globe. And you started to see, if you went to a big ICGN or ACGA or CII conference, you'd have like one breakout session on ESG, right? This is in the late aughts, and now you have whole conferences and whole asset classes dedicated to ESG. So I've kind of been on this ride for a long time and seen the growth from just looking at governance, and then ESG kind of being born, and it started as just a simple data set. People thinking, okay, this is a data set of kind of non-financial information that can be material and can have an impact on the investment process. So if I'm a portfolio manager or I'm an analyst, I need to understand this and where it's material. And as is the case with all good things, it's gotten a little out of hand of what ESG is and isn't in people's minds. It's gotten a little too popular, maybe. But one of the tricky things about ESG is there's no real one definition of what ESG is. It's become so trendy and so popular, and I'm not disparaging that. It's gotten to be where if there's an ESG fund that someone's offering, you really have to do your homework to see what's behind that fund. Why is it called ESG? It could have been it could have been a different fund last year, and the name was just changed to cash in on the ESG trend. You have to see what assumptions are behind that, and if it really matches what you, as either an individual investor or an institutional investor, want to either tilt your portfolio or consider when you're thinking about ESG or sustainability.
Matt, going back to you personally, I mean, you've been with the CFA Institute for a while. You talk to a lot of stakeholders, including investors, I'm sure investment banks, etc. In terms of, everything that is climate finance and investing or ESG finance and investing, would you say that now you're spending most of your time on this topic, and how does that compare to, say, 10 years ago?
Yeah, no, I would say I am. I would say probably around 90% or more of my time is spent on ESG sustainability issues, with the podcast, with the research I do, with the speaking I do, with the writing I do. Most of it is focused on ESG or sustainability. And I've kind of grown with the description I talked about how we got here, how ESG has grown. Started again just looking at governance, and I kind of went along, have been around long enough to see where ESG was and where it was going. And even 5 years ago, we did a big project with PRI where we went Principles of Responsible Investing, where we went around the world and to gauge from people. I think we had about 29 meetings with folks around the world to better understand how they were integrating ESG in the investment process. And that was very, very, very new for a lot of people. The paper we wrote was the feedback we got was it's very helpful because it helped people understand how to integrate ESG in the investment process. And part of that was we did 33 case studies. We partnered with firms to show people the how of how to integrate ESG in the investment process, whether it was equities or bonds or sovereign debt. A lot of examples to show people how to integrate ESG in the investment process. So just 5 years ago, this was very, very new to people. And I probably was spending about half of my time then on ESG and sustainability issues. Now it's most all of my time.
Great. I mean, I published a book last year, as you know, and I did talk about climate finance quite a bit. And one of the kind of my prediction as a former equity analyst, and hopefully I won't be held liable for it, but I was saying that, at the end of the day, all types of finance is going to become, is going to have to take into consideration climate finance and investing. So, now there's bonds and green bonds, but in the future, I think most bonds will have to have a minimum amount of, green parameters, even for those sectors who try to ignore it. But going back to kind of what you were saying earlier, can we talk a little bit about the disparities between, and just to pick three regions, Europe, North America, and Asia? I think the general sense is that Europe is relatively more advanced when it comes to policy, when it comes to regulation, when it comes to implementation. The US in some areas is not far behind, and Asia is still lagging. Do you have any particular views on these three jurisdictions, the continents?
Yeah, I think you have to take into account just how different they are. I don't think Asia is too far behind. I just think it's so spread out in so many different jurisdictions. I talk to people in APAC all the time, and they're up to date on what SASB is doing, what TCFD is doing, what the ISSB is doing. But they also have to take into account what their own regulator is doing, whether they're in India or Japan or Australia or Hong Kong or Singapore or the Philippines and so on and so on. That the sophistication isn't much different. The investors I talk to and the analysts I talk to, it's just in Europe, you have the European Union. You have a huge body that is, for the most part, going in the same direction on these issues and is leading on these issues, whether it's regulation or the EU taxonomy. And the US is, behind, I would say, from folks I talk to, the US and Asia, North America and Asia are generally around the same level of understanding and sophistication. They're just not as far along on regulation and policy. One, in the US, it's become a political issue here. And there's pushback on anything, green or climate related. Whereas in Asia, it's just that there's all these disparate markets, and you're just not going to have coordination. Australia may be ahead on regulation one area, but Singapore is ahead on regulation in another area, and Hong Kong is a leader in another area. And so the sophistication of conversations that have and the understanding of the issues isn't much different. It's just I think people outside Asia don't appreciate there's not one system where there's not one huge system such as the European Union or such as the US, where if something happens, it has that big of an impact. Like for example, the SEC's proposal on climate related disclosures. That's going to have we just finished the discussion stage of it. It's going to become a rule soon, and that's going to have a huge impact. Just the size of the market. Same with the European Union. Now, if Singapore did that or Australia did that, it would matter, but it's just the impact isn't going to be as big. And the same with the climate plan that just went through the Senate here in the U.S. I think it's going to become law this week. Biden will sign it either this week or early next week. Just under $400 billion dedicated to climate. Well, that's huge. But if Australia or Japan passed something that was 50 billion or 60 billion, it would be huge in that market, but it's not going to have as big of an impact. So, to sum up, I think the sophistication on the issues around the world, everyone's come up a lot since 5 years ago, since when we first started talking about this. I think you have to appreciate where you're having the conversation about sustainability. Because in Japan, that's going to be different than it is in Hong Kong, and it's going to be different in Singapore than that, and it's going to be different in Australia than that, and so on. Or in India is going to have different issues. So you have to, if you're a practitioner in Asia, you have to take into account what are the cultural norms in different markets? What is the legal structure in different markets? What's the policy in different markets? Whereas in the States or in Europe, everything is so big, you don't have to consider those things.
And do you think that, we've got the kind of international finance, accounting standards, and soon we're going to have that on the sustainability front. Do you think that that's going to help a little bit to have a more harmonious and united approach? Or do you think that, Europe will still do its own thing and the US will still do its own thing, and there's still going to be some disparity?
I think there's still going to be some disparity, but I think over time they will coalesce. But I preach patience on these issues, and the analogy I give is, we've had double entry bookkeeping and accounting for a couple hundred years now, and we still can't agree globally on what to do on accounting standards. So it's going to take a while to get consensus on sustainability ESG issues, and we're never going to get complete. Everyone's singing from the same song sheet, for example. For instance, but I think that there will be, as the SEC comes out with their stuff, and as European does the same, and the ISSB does the same. I think the ISSB will kind of help set a bar, kind of a floor for disclosures for companies, and then each jurisdiction can kind of gold plate those as they wish. If they think this issue is more important or a different issue is more important, and the ISSB says that. They understand that they need to give folks in India and Japan and the Philippines and Thailand some flexibility to take into account the situation, policy there, the law there, the investing culture there, and liquidity of the markets, the kind of markets, and so on. So I think you're going to have a good baseline that's going to help coalesce thought around what the EU does and what the US does, and what the, and so forth. And I don't think people should be waiting for a consensus on everything. I think like I said, a little humility and patience is what I counsel. Think where we were 5 years ago and think where we are now. And don't settle for that. Keep pushing for better regulation, better disclosure, but don't let the perfect be the enemy of the good.
Right. Now we've gone already through a lot of materials, but I wanted to kind of go back a couple of steps, and I wanted to talk about the sustainability story. Sorry, not your podcast, which is called The Sustainability Story, but I was thinking more about the forces that have created what I would argue is an unshakable momentum towards the greening of finance. And I think, as you and I have discussed, the train has already left the station, whether you like it or not. And, it may be moving, different trains in different countries may be moving at different speed, but they're pretty much moved already. So if you stand by and watch, then you'll miss the train. So if you are an institution, a financial institution who's been a bit slow in looking at things like green lending, like we have some of the kind of like banks in Hong Kong or banks in I don't know, Malaysia, for example, they're going to have to catch up real fast. So going back to what I was trying to say is, could you talk a little bit about the sustainability story and what has created this kind of unshakable momentum towards the greening in general of finance? It's a big question. Sorry. In 30 seconds. No, just kidding.
Yeah, I don't know if I could do that justice in 30 seconds.
No, I'm just kidding.
Well, I mean, to build on some of the story that I've been talking about before. I mean, this started years ago, and it's gotten acceptance that this information can be material, It's gotten popular in investors' minds in that, people want to tilt their portfolios green or invest in things that are green or make the world a better place. And I think that's not going to change. It's not going to go away. It's only going to grow in strength. I think we're in a little bit of a hiccup right now. ESG is getting its nose bloodied, for lack of a better term. It's in the past couple of years, ESG funds and ESG investing was fairly easy. You would tilt away from oil and gas companies, and you'd outperform. Well, now we're in a year where that isn't happening anymore, and I think people are beginning to realize the emperor has no clothes sort of scenario in some cases. There's greenwashing out there of funds. There's greenwashing of analysis. There's greenwashing from companies. There's greenwashing in companies marketing themselves and financial firms marketing themselves as green. You've seen a proliferation of folks with the title of Chief Sustainability Officer or Chief ESG Officer. And I know a lot of these folks, and a lot of them have come up in the ESG ranks and have ESG experience, but some of them were something else last year, and their firm wanted to cash in on ESG or sustainability, and so now they're the head of sustainability, or now they're the head of ESG. So I think there's momentum. I think we're in a bit of a hiccup now, and I think that's healthy. I think we were talking we talked last week. We're talking about the Economist came up with their issue on ESG, their special report on ESG. I've seen a lot of pushback on ESG this year, and I think that's healthy. I think the shakeup on ESG was always coming. It was just a matter of when. And like I said, when you have something that no one can agree upon what the definition is, it's going to hit bumps in the road like this. What I would caution investors and analysts to think about is that a lot of what we're talking about now in ESG and sustainable investing is small tilts to a portfolio or trying to take advantage of a small opportunity or to avoid a relatively small risk to outperform in the short term. And that's fine. That's markets, that's capitalism. But I think what I've seen people lose track of in the finance world is the bigger picture of just how scary climate change and issues in natural capital can get. We're currently in the sixth major extinction in the history of Earth, caused mostly by us and climate change and other pushing beyond other planetary boundaries, and that's an issue I would invite people to look into more on their own. We push past many planetary boundaries, whether it's climate change or phosphorus and nitrates in our system, in our water, land use, acidification of oceans. You can look this stuff up. But where we're headed is a place where if we don't get our act together, for lack of a better term, there won't be markets to invest in. There won't be economies to invest in. Anything like we've known in our lives. I joke that, they don't talk about, you never see them talk about the market or markets in Mad Max movies because there aren't any. And if I don't think we'll get to that point, because I think people will realize, people are already starting to realize some of the problems we have, some of the scary problems we have, and taking them seriously. But we still have baked in 1.5 degree rise, 1.5 Celsius degree rise since the Industrial Revolution, and that's something that we're going to pass in the next 10 years. It's just there's no going back from that. And 2.0 by 2050 looks in doubt unless things change. And the I think it's it's just under $400 billion in investment in climate mitigating technologies in the U.S. and incentives, and that's great. But you read the IPCC report and other reports that call for over $3 trillion of investment every year globally for the next decade at least. So that 400 billion is just a drop in the bucket. And so people really need to think beyond 5 to 7 years for their portfolios and think about, you need to make sure there is a market to invest in 15, 20 years down the road. Because step back and think about all the long-term things we invest in. We invest in houses that have 30-year mortgages on them. I know in the U.S. in some places it's a little different, but long-term mortgages. How are you going to, if you're buying a house today and you're in a place where the ocean is going to come and take that place away or flood it, every other day in 30 years, you're not going to be able to sell that house. So what is that mortgage worth? If we stay on, the current path we're on, investing for college education. I have 4 young kids. Are they going to want to go to a college in a 2.5 degree world? Are people going to invest in that? Are people going to invest in retirement? We're set to have, one of this, not to be too much of a downer, but one of the scarier numbers I've come across is, think about the Syrian refugee crisis we had for the Syrian civil war, about a decade ago, and it's, there's the effects of that are still being felt. And I would have to look up the exact number, but it's something like 4 to 5 million refugees were displaced because of that event. And think of all the horrible stories that came from that. Estimates for displaced peoples over the next 30 years, roughly, in the business as usual scenario, is about, and again, this number could be a little off, but it's in the neighborhood of about 1.5 billion people will be displaced in the next 30 years. So think of that refugee, those refugees. They're not all going country to country, but just here in the United States, there's going to be refugees from places that are going to have, very much hotter weather and a lot more flooding, and that will cause problems. I've already heard, like the state of Arizona, people are moving from the hot south to the cooler mountainous north, and that's causing some disruption. So I would caution people to have a little humility about what finance can and can't do. You can't solve climate change by investing in an ESG or climate fund, because climate funds, ESG funds, are simply meant to be a reflection of what the future state may be. Our best guess of what may be a year from now, 5 years from now, whatever it may be. But that doesn't change very much what that future state is. That comes from policy, mostly. So, like the example of what just passed in the U.S. Senate, that's policy that will change things, that will bend that curve a little bit down. But we need a lot more of that, and we need it globally in all the markets that your podcast goes out to. In the European Union, in China, in Australia, in Japan, and so forth. So, yes, as an investor, do what you can to benefit from risks and opportunities. But as a citizen, as a person on this planet, think about what needs to happen to incentivize changes in the way we live our lives, because we have we can't stay on the same path and have markets in the future, anything like we have today. Those things will go away if we don't change. Civilizations have collapsed many times in the history of humanity, and that's where we're headed if we don't change things.
And I think that the people who have this kind of short-termist views, first of all, they fail to understand a couple of points that you mentioned, which I think are extremely crucial, is that this is an evolution. It's just like the international financial standards, accounting standards. It took decades for them to evolve into something which is pretty sound and robust, relatively robust today. So the whole, whatever you want to call it, climate finance, ESG finance, et cetera, it's an evolution. It's going to take a little bit of time because governments, institutions, corporations are only now kind of getting their head around it. And it's very, very, very complicated. But also the other point that you made about advocacy and government policy, I think few people in the financial kind of markets fully understand that, it's actually up to them to push governments as well, because if you're able to have a transparent and consistent government policy, you actually do reduce your cost of capital. So if you look at, for example, energy, Australia is a great example where you had very strong state level support towards clean energy projects and zilch from the federal government, which was a climate denier and promoter of the fossil fuel industry. And all of a sudden, the Albanese government, the Labour government came through, and they are not climate deniers. And all of a sudden, your cost of capital has come down because you've got a little bit more longer term certainty over government policy. So you will do that investment, especially for long duration assets, and not just energy, but also railroads, real estate, toll roads, et cetera, any long duration asset, you really need that government policy. You mentioned something about the funding of, and there's, decarbonisation, the funding towards a net zero world. Could you give me a little bit more thoughts about, where do you think, what's the state now? I mean, do you think that there's enough money around and are people who have the money, are they deploying it, to put it simply?
Yeah, and again, I think people need to keep in mind two different things. There's two different goals about climate. There's net zero by 2050 that you hear all the time from governments, from companies, and that's only one step. That's only part of it. If we remove all the carbon from if we put no more carbon in the atmosphere tomorrow, all over the world, we'd still be in a big problem. Net zero 2050 is a great goal. And with where I see the current state of technology and the rate of change, where solar and wind are already price competitive around the developed world, most everywhere, and more economical. Whereas in 5 or 6 years, or I think by the end of the decade in the U.S., there won't be coal-fired power plants anymore. There's already states in operating. That's already state in many places in Europe, and they're on that trajectory as well. The technology is speeding up and will get us close to net zero 2050. When we hit net zero, I don't know. The sooner the better. But we're headed in that direction. And yes, we need more investments like the U.S. just did, but globally, and the U.S. will have to come back and do more, I'm sure, in the future. But you still have all that carbon dioxide and methane in the atmosphere. Carbon dioxide could stay in the atmosphere for centuries. And so part of what we need to do is ramp up sequestration of CO2 and methane. And a lot of those technologies are, we have oceans and we have, trees that do that, but there's also technologies such as direct carbon capture that just aren't economical now. But I expect to see a lot more in that area, and it's needed because, like I said, there's really two things when you're talking about climate change and mitigating the worst case scenario. Yes, net zero by 2050 is part of it, but it's only one part. The other part is removing all that carbon dioxide in the atmosphere and really focusing on what's the parts per million. number. Right now, we have about 420 parts per million. I haven't looked at it in a little while, but it's about 420 parts per million of carbon dioxide. But if you add in methane and other gases, I saw a report that's approaching or over 500. I've seen people on people's LinkedIn profiles and other places, they'll say, their name, their affiliation, and born in the year of, 383 parts per million or 350 parts per million. And to get in a safe space, we really need to get under 350, even under 300 parts per million. We've flourished as humanity for 10,000 years now in a space that was mostly under 300 parts per million. And net zero by 2050 doesn't touch that really. That's just the first step. The second step is getting that CO2 out of the atmosphere and sequestered before methane permafrost in the Arctic melts and exacerbates things. There's a lot of nasty feedback loops that we can get to if we don't do that second part of getting carbon dioxide out of the atmosphere. And that's another whole podcast. There's a lot of interesting stuff people can do from, just to think the future state of the world. There's the consumption of beef and meat, but mostly beef and dairy. And I'm not picking on beef and dairy. My wife's a vegetarian, so at home I'm a vegetarian. My kids are vegetarians, but I eat meat. I have been a vegetarian in the past. There's no value judgment on this. It's just that if you look at the carbon intensity of everything, beef and dairy are just off the charts. Carbon dioxide, and it's not just methane from cows. And water use as well. That's another issue. And so as people realize that, and as governments realize that, governments and companies are going to realize, and they already are starting, that they can hit their targets by taxing that more, and people will move away from eating as much meat, for example. And I just see this as a natural evolution as people understand it more. There's a great map of the U.S. where it shows, I came across a year or two ago, where it shows land use in the U.S. by type, whether it's, there's just a couple squares for golf courses and for housing and for national parks, but the huge square in the middle of the country that uses about a quarter of the U.S. land that's for grazing of cattle. About a quarter of the land. And so what if that was cut in half in the next 25 to 30 years? Again, this isn't a value judgment. This is where I see things going. Say that's cut in half in the next 30 years. Well, that's 12.5 or roughly % of U.S. land that you can reforest or rewild, for instance. And that helps. You're mitigating CO2 by taking it away from the beef and dairy industries. They're not emitting that as much, and you're soaking it up with reforestation. So that's one example of hundreds of different examples of ways, that I think people will be focusing on getting CO2 and methane out of the atmosphere.
No, that's great, and all the points well taken. I wanted to move on a little bit to talking about kind of the ABCs of all of these different initiatives, for lack of a better expression, including the United Nations Sustainable Development Goals, the Principle for Responsible Investment, the Task Force on Climate-Related Financial Disclosures, and the various things that are happening on the ESG front, as well as climate risk front on the part of entities like the SEC in the US or SFC here in Hong Kong. But the one thing that kind of bothers me, and if we're talking about what's going to happen next 10 to 20 years, is really the bubble as in BABBLE. If we just take, for example, just one dictionary, say the Cambridge English Dictionary, it says a bubble is to talk or say something in a quick, confused, and exciting or silly way, which is, this is, in my view, what's happening when people discuss ESG or ESG investing. In our pre-podcast conversation, you said something which I think is extremely important. It was along the lines of, in a few years, we won't be seeing the initials SG anymore in general conversation, but all financial analysis in capital markets is going to be ESG analysis, something which is driven, by the capital markets. These are my words, not yours. Sorry for misquoting you. And secondly, could you talk a little bit about this concept, which I think is really important for people to understand? And then secondly, could you please talk to, get your crystal ball out and tell us, what you think the world of climate finance and investing will look like in 1, 2, or 3 decades from now, in general and in Asia specifically?
Yeah, I'll first start off by saying that I don't think there's any such thing as ESG investing. And the reason for that is that, like I said before, we can't agree on what ESG is, what sustainability is. And a lot of the ESG products or sustainability products you see out there are just, riding this wave, cashing in on this popularity. And it's an interesting story about how we got here. I did a guest on my podcast, not to plug my podcast too much, but he used to be an analyst at MSCI, and he helped create. His name's Matt Orsagh. He was on the team that helped create these ESG ratings, and they were meant to measure risk and opportunity. Right? They were mainly a risk measurement tool, and over the years, they've got turned into, one of the ways people form ESG funds, and that was never their purpose. But I'm sure, when a fund company says, "Hey, MSCI, we'd like to pay a little bit of money to use your ratings for our fund," they're going to say, "Yeah," because that's just, they're not going to say no to that. And so these funds have grown that, call themselves an ESG fund or sustainability fund, and they're based on, and I'm not picking MSCI, there's just one index people use. People use others as well.
Yeah.
And they don't necessarily agree with each other, and that's fine. They don't have to agree with each other. MSCI can have an index that's different from, an ISS index or a Reuters index or whoever, or a Dow Jones index or S&P index, because what's the recipe behind that ESG is going to be different. And that, again, that's fine. But when grandma buys an ESG fund because she wants to save the world or wants to, tilt her portfolio away from, carbon or whatever it may be, it doesn't really do much. And so I caution people to, whatever conversation you're having about ESG, whether it's a broker talking to their client, on the individual level, or a consultant, or big portfolio manager talking to an institutional investor, start the conversation with, what are we talking about? What do we mean by ESG? What do you want from ESG or sustainability? Is it climate? Is it something broader? Is it, because this word is meaningless unless we have agreement on what ESG means. Now, that said, I don't think there's any such thing as ESG investing. I think there is such a thing as ESG analysis. Integrating material ESG factors, whether it's E or S or G, into an investment process is just fundamental analysis. That's all it is. It wasn't done as methodically as it should have been done 20 years ago. A lot of the tools didn't exist. A lot of the information wasn't sussed out, wasn't pulled out. Now it is. Now it's there. It's going to keep getting better. But think about, what I was talking about in the beginning. Corporate governance started making its way into the CFA curriculum nearly 20 years ago. And business school curriculums about the same time. The E and the S began making its way into the CFA curriculum about 13 years ago. Same with business schools and MBA programs as well. So you have a whole generation or two that just accepts that you have to integrate ESG in the investment process. You just do it. It's just analysis. And so what I see is in 3 to 5 years, ESG will, as a term, will kind of fade away. We've had kind of a bubble of ESG excess. We're kind of in that ESG reckoning now. I think the number of ESG funds will shrink Think about a good analogy is think about how many tech funds there were in the year 2000. How many tech funds were there in the year 2005? Not that there weren't any, but a lot of the fly-by-night tech funds that there was no substance there, or consultants who there was no substance there, or money managers who there's no substance there. They went away. They kind of got filtered out. I think ESG is kind of in the same moment. And I think in the long term, ESG it's just part of analysis. It's just a data set you use for analysis. And as things like the ISSB and the European Union and SEC help codify with the help of folks like the SASB and the TCFD, and now the Task Force for Nature-Related Financial Disclosures is another one that looks at those planetary boundaries I talked about earlier. With groups like that, you're going to have more of this information at people's fingertips. Just be part of analysis. It's just going to be part of analysis.
Yeah, but what's been interesting though, and now you bring up the tech boom, because in the late 90s, I was a utilities analyst, and when the tech boom appeared, I was the least loved equity analyst in terms of sectors around. Felt very, very lonely because people said, who cares about CAGR of 5, 10, 15% when I can get 200, 300%. And then we had the infamous, valuations. You couldn't use PE because there was no E. And so you went into, EV per customer and all sorts of other things. I mean, as valuations rose, you had to change your valuation methodology, which I thought was really interesting. With ESG, we call it greenwashing, but there was tech washing. A company that actually wasn't doing really something that was tech, but they just thought around, can we have a construct so that we've got a tech angle on what we're doing? And they may be just selling dairy products. And now I think with I don't know if you agree, what's happening with greenwashing is that there is people that just want to use the green insignia, so to speak, just to sell something. But there's also amongst funds and companies, because of the lack of understanding, they're doing something and then it becomes greenwashing, not because they want it to be greenwashing, but just because they don't understand the subject matter. For example, we had a DWS scandal where the ESG methodology wasn't robust, et cetera. But I'm sure that there's some people out there that have adopted a methodology and they think it works, but then when it goes under scrutiny, people say, well, hold on, this is not the way you're supposed to do it. And all of a sudden they're accused of greenwashing, although their purpose was, they had good intentions basically, but it got sidetracked.
Yeah, like as I said before, I think we're just in the process of kind of an ESG reckoning, where whether you're an investor looking at companies, or you're a large institutional investor looking at portfolio managers, get back to that initial conversation. What are we talking about here? What do you mean by sustainability? What is your process? If I've seen a lot of, in the last 5 years, a lot more investment from investors and engagement with companies and their board. Where 10 years ago, boards wouldn't take calls from investors, wouldn't want to waste their time. So making air quotes, you can't see because it's podcast, with investors. But now they realize that they need to do that because their competitors they want to listen to their investors, to hear from investors what's going on out there, what questions do they have. Looking at investors as free consulting, if you will. And I think I think both sides of that equation should make more investments and engagement on this more topics, but this topic in particular, because it's so new to a lot of people. And investors are trying to figure out how to do this. Companies are trying to figure out how to do this. And so you can never assume that, never read a sustainability report or a shiny ESG report from a company and think all they have to say. Talk to them if you can about their strategy and what their plans are. The TCFD is the Task Force for Climate-Related Financial Disclosures is a great model because it's kind of a template for engaging with companies. You need to know what is their strategy, how are they governing things internally, what metrics do they use, how do they measure what they're doing, and the same for the nature-based financial disclosures that are just starting. And if companies don't have a good answer for that, well, that's a problem. But at the same case, if you're an investor, you should know, how is that fund company, how is that financial firm integrating this into what they do? And they should have a good answer for that. And they should be able to tell you succinctly, but if you want to have a longer conversation, how this is done. They don't have to give away any secrets, but you should be able to, at the end of that conversation, understand whether they're serious about this or whether it's just greenwashing. Kind of a trust but verify kind of a thing.
Matt, just to end your kind of outlook in the future, what do you think that the capital markets world is going to look like 30 years from now when it comes to the whole kind of impact investing, ESG finance and investing, et cetera? 30
years from now, ESG won't be around. I don't think it'll be around maybe 5-10 years from now. I think ESG and sustainability will just be baked into the investment process. Think 50 years ago what investing was, and then 10 years after that, a lot of things had changed. 10 years after that, a lot of things have changed. It's just, and like I said before, the past couple of generations, have just learned that, for the past 20 years, this is what you do. You integrated this into the investment process. So I don't think we'll have something separate. I agree with you in that a lot of finance, I've seen a lot of rating agencies start to do more and more around integrating ESG into what they do. That's something we haven't talked about, but I think is already at the forefront of this is the insurance industry.
Yes.
The insurance industry is just going to stop insuring things in certain places. And that's kind of a canary in a coal mine. If you have beachfront property in southern Florida, and the world isn't moving fast enough to stop, sea level rise, Miami and other southern Florida cities are in deep trouble. And that's the case with other places around the world. I'm not picking on Miami. But other large, think of how many people in the world, and the answer is billions, plural, live in huge cities right on the water that are, that a half a foot of sea level rise in the next 30 years would do great damage to. And that's just one climate issue. There's also heat stresses. There's also food production is going to be challenged. The breadbasket of continents is going to move. And what we do about that, agriculture is going to change. The auto industry is going to change. Everything's going to change. But I agree with you when you said earlier that, this is just going to be baked into the investment process, whether it's bonds or equities. And I think, as I said before, the big challenge is just the speed with which we do this. And it's, we're in the finance world, so finance should do all it can, but to understand it can only do so much. And that it really needs to work with companies and policymakers to get the incentives right and get the policy right to ensure that we can have healthy markets 20 years from now. And that's the real challenge before us.
Just a couple of final words. So the Asian Climate Capital podcast, the whole idea behind it is, knowledge sharing, education in terms of, for people who are not as familiar with climate capital, what it is and how it's working, how the whole greening of finance in general. Could you just please plug your podcast? Tell us a little bit about your podcast, because I think it's a great resource. And also, although today, it's purely your personal opinions, obviously, but could you also tell us about some perhaps resources that investors or other listeners could get from the CFA Institute when it comes to the whole kind of ESG finance and investing?
Yeah, I would tell people what I would say about any kind of information. Don't get it all in one place. Seek out a lot of different points of view, and that's one of the things I try to do on the podcast. Is we just celebrated our 1 year anniversary the first week of August. We had our first podcast last year, the first week of August. And we haven't had the same topic. We go every other week. So that's 26. I think we're up to like 28 podcasts now. We've done 28, 29, because we've recorded a couple since then. We haven't repeated any topic in sustainability, because there's just so much out there. We did an episode on water. We did an episode on plastics. I just recorded one on the oceans. We did two separate ones right around COP26. We did one a couple weeks ago on degrowth and the whole degrowth movement, and that was actually the highest downloaded podcast we have. We did, like I said, we did one on rating agencies and how that came about. We did one, a friend of mine who's a consultant, works with companies on storytelling. He's a writer and a storyteller. The story behind sustainability and the storytelling of anything in life, but we are the stories that we tell ourselves. And what does that mean for sustainability? And what story are we telling? And how do we get that? What story do we tell to get to where we need to be? And those kind of things. So that's the ethic of the podcast is I don't want to be talking to fund manager X about how they're integrating ESG in the investment portfolio. And the next week talk to portfolio manager Y. We've done a little bit of that, but we try to go to a lot of different places. And so I tell people to go to a lot of different places. I get a lot of information through LinkedIn. I follow people that and get information from, and then follow the people they follow. And so I've grown my community. And so the first thing I do in the morning is look at LinkedIn and see, okay, what are the stories? And Twitter as well, but LinkedIn is more finance business focused. What are the stories I need to know about? And there's a bunch of online resources. ESG Today is one I look at. Environmental finance is another one. ESG Clarity is another one. Green Biz is another one. But you're going to have different ones for, I read FD in the journal, all that stuff. But if you're in Japan, there's going to be stuff that you need to know about what's going on in Japan. If you're in India, if you're in the Philippines, just a lot of it is just reading, a whole lot of reading and research, and just if you're curious about something, just dive into that rabbit hole. And feel free to bother me on LinkedIn if you have any questions, and I'll happily respond.
Well, it's really like an investment approach, isn't it? When you're doing the analysis as a financial analyst of a company, you just don't just talk to the company. You talk to its competitors, the other peers, suppliers. I mean, the whole kind of value chain to get a better idea, on how to look at future earnings and a whole variety of other things. Great. Well, listen, Matt, it's getting very late your time, and I really, really appreciate the conversation. I think it was really, really great. And listeners can go to the Sustainability Story, which is on Apple Podcasts, Spotify, and others. And also, I think that the CFA Institute website has also got some of your insights as well. And I found those very, very, very valuable. So once again, Matt, thank you very, very much for the conversation.
Thanks a lot for having me, Joe. I appreciate it. It was fun.
Thank you for listening to the Asia Climate Capital podcast. If you want more information or you would like to send some comments or ideas for future topics, our contact is in the show notes. Thank you again.